Hi, this is Stephen here from Share Navigator with an outlook on the S&P 500. So we're going to discuss what's caused the recent sell-off, where can we go from here, and what are the potential catalysts down the line. So first of all, you can see it's a big move from here down to here. That's a 10% correction from the peak to the trough, more than 10%. And the main driver of this has actually been tech stocks. I think 50% of Nasdaq 100 stocks now have corrected more than 50% at this stage. So that's a huge sell-off in technology shares. And that's helped, I suppose, bring the S&P 500 down with it as well. So a couple of factors, of course. You have the Federal Reserve. Inflation is front and center, of course. We've gone from quantitative easing to we're moving to quantitative tightening. And what's happening now, there's a re-rating of technology stocks. So tech stocks won't be trading at the lofty multiples that they were before. And especially the technology stocks that are losing money, they're absolutely getting crushed and slammed at the moment. But it is creating quality and value in there as well. So there is pockets of value. So some of the big names, the likes of Facebook, Google, for example, we think there's good value there. But in general, there's still more pain to come for other tech stocks in our view. And the reason is we did a study in a tightening cycle what the valuation multiples normally would be, and it would suggest actually we could even have another 10% to go to the downside here before we get to average valuation multiples over in an interest rate hike tightening cycle. So tonight you've got the Federal Reserve. They're speaking at 7:30. They're going to make their policy announcements. At this moment in time, the market is pricing in 4 interest rate hikes this year, plus in July the start of the tapering of the balance sheet, or not the tapering, the reduction in the balance sheet. So ultimately what that means, we've gone from the Federal Reserve to being buyers of bonds to being net sellers of bonds, and investors are now concerned, what does that mean for interest rates? And again, just back to technology, why technology is getting re-rated is because, tech shares tend to get valued on discounted cash flow models. And if interest rates are going up, the cost of capital goes up. And when you discount that back to today's value, it gives you a lower share price. So the pain may not be done just there yet. Having said that, we could be prepared and set up now for a short-term rally. If the Fed gives some half-decent news tonight, market could rally on the back of that. Microsoft had earnings last night, which were very good, bet all expectations, and they raised guidance for the year. We still think they're not a buy yet, by the way, on Microsoft. But that, will give, I suppose, tech shares a bit of a lift today, which will bring the broad market indices up. So you could actually see, in my view, a 5 to an 8% rally here. But I think overall, we still were potentially on the S&P 500 going down here, because that's where the valuation models would actually expect the S&P 500 to go based on a rate tightening cycle and the current earnings outlook for 2022. So we still think 4,000 is on the cards for the S&P 500, but we're going to get short-term rallies, and there'll be violent rallies and violent sell-offs, and that's the way it's going to really play out in our view for the next 3 to 6 months. So why do we think there's a rally on the cards? Well, if you look down here at some of the momentum indicators, Stochastics grossly oversold here and looking to set up a buy signal here. And then if we look at RSI as well down below, I'll just actually get rid of Stochastics here and just bring RSI out in a greater detail. When RSI gets down to these extreme levels down here, usually it's followed by a bit of a rally. And if you go back over a period of time, you can check that yourself. You can see, RSI, that's not even as extreme as we are now. Rally afterwards. If we come to here, rally afterwards. And if we go back over periods of time, you can see that, usually the result is a significant rally after such a sell-off. So we think that potentially, just technically speaking, a bit of good news this week in tech earnings could give this market a bit of a rally. I think it will be short-lived, but it could be a significant rally, maybe 5-6% to the upside. We would be building protective defensive positions into that rally. We're still buyers of stocks in these pullbacks, by the way. We're looking at value stocks. We see great value out there. In our Stock Investor Club, we've outlined them. The reopening trade, some of the shares that haven't benefited yet from COVID going into the rearview mirror. They're set for a bounce. So we think there's a number of catalysts to give us a short-term rally. But overall, in the first 3 to 6 months, we could see the market down another 10% from these levels. Okay, this is Stephen from Share Navigator with an update on the S&P 500. Thanks and bye for now.